Welcome back to Market News. I'm your host, and this is Saturday, August 23rd, 2026. Let me open with this. The one word that defined markets this week was damage. Down, 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 until finally something had to give. And it did. The Nasdaq recorded its biggest single-day decline since 2022. The Dow Jones followed suit, and by Friday afternoon, the damage had clearly stopped bleeding. So what's the read as we head into the weekend? Is this a relief rally after the worst of it, or just a pause before the next leg lower? Let me walk through the headlines that matter today, and I will tell you now, they all connect to one story. The AI boom is hitting its own bill, and that bill is coming due next Tuesday, when Nvidia reports Q2 earnings. The market damage this week was, in part, the market digesting a hard truth. Nvidia is the engine of the AI revolution right now. But the engine is getting expensive. According to multiple reports, Nvidia has warned its top customers, Microsoft, Google, Amazon, Meta, of a 15% price hike on AI servers. That hits every one of the Magnificent Seven. Apple, Costco, Samsung Electronics, the entire supply chain built around this boom is about to get a shock. And it gets more uncomfortable. Amazon's free cash flow went negative by $7.6 billion, even though operating cash flow rose 33%. That is a massive gap. The company is spending enormously on AI infrastructure to protect its cloud and logistics moats, and the cash flow implications are stark. Amazon trades at just 21.3 times forward earnings. You would think that's cheap for a top growth stock, but it trades at the same multiple as the S&P 500. So the question on every portfolio manager's desk this week was, is Amazon still a growth stock, or has the capex burden turned it into a value trap? Billionaire David Tepper clearly thinks it's still a growth stock. He has 16% of his $7.5 billion Appaloosa portfolio in Amazon. He is not hedging. The market is. Same story at the mega cap level. Microsoft dropped 30% from its all-time high. Motley Fool is calling it one of the cheapest Magnificent Seven names right now, with two reasons it could double by 2030. Google is in the mix too. Google trades at a single A-share premium and the market is pricing it as if AI is already reflected. But Alibaba just launched a record $10 billion share sale, the biggest ever by the Chinese tech giant, specifically to enter the AI race. That is a massive signal from a company that has been sitting on reserves. If Alibaba can spend $10 billion just to catch up to OpenAI and Google, that tells you how hungry the competitive landscape has become. Intel is one of the tickers mentioned alongside that story, and the market is watching to see whether the stock can benefit from any domestic reshoring of semiconductor production. Now back to Nvidia for a moment. Nvidia's Q2 earnings are the single biggest event on the calendar next week. The stock sits at $214.72, with almost 100 million shares in volume today. The prediction I want to highlight, only one publisher, so take this with a grain of salt, is that Nvidia could hit $6 trillion before 2026 is over. But let's check the technical reality. Our signal scan covered 10,791 symbols and pulled 9,471 total signals. 15 bullish, 35 bearish. That is a 2-to-1 bearish skew. The most common title across the bearish side is potential overextension on names like Entwao, Arfeu, and BTOG. The other cluster, overbought territory, flags XCH and Nexer. On the flip side, 5 stocks earned strong momentum up notes: PFSA, TPC, RFI, Arfeu, and IPST. Those are mostly microcaps and penny stocks, so they are interesting but not necessarily indicative of broader market direction. Speaking of movers, the volume and price action this week tells a story of dislocation. RDoku gapped up 53%, UXB and XRPT both climbed over 30%, and MRAL and XXRP ran over 29% and 30% respectively. Ethereum-related ticker ETH jumped 21%. On the bleeding side, MRNX crashed nearly 48% on almost 2 million shares, MRNY and ETH fell over 22%, and SBIT took a 12% hit on high volume. These are not S&P names, they are smaller, more speculative issues, but they illustrate how rotation is happening. Money is moving hard between stories. If you are not paying attention, you will be left behind. Let me switch to one of the most talked about pieces of corporate news from a few weeks, and it is still rippling through the weekend. Berkshire Hathaway's CEO, Greg Abel, is sitting on nearly $400 billion in cash. $400 billion. This is not a typo. That is the amount of dry powder Warren Buffett left behind and Abel is holding. Here is the difference. Buffett was famous for deploying capital when fear was high, buying great businesses at fair prices. Abel is known for a more analytical, structured deal-making approach. The question on every investor's mind is whether Abel will move this cash into mega-acquisitions once the market bottoms, or whether he will sit it out and let the next cycle play out. Berkshire bought Meta and sold other positions this week, so the trading activity is not exactly idle. Trump, not the former president, the Berkshire-linked trader, has been moving at warp speed according to reports, with Berkshire's book shifting rapidly. On the bond side, Treasury Secretary Bessent has been under fire for rising bond yields, and the press line from Monday was unambiguous: there is no easy fix. Google, JP Morgan, Ing, those are the yield beneficiaries right now as rates climb. Investors in bank stocks like BAC are seeing bullish sentiment surge. The BofA investor survey this week showed cash levels near historic lows. That means the investors who had been hoarding dry kindling are finally running out of it. Historically, that can be a contrarian bullish signal because once cash is gone, you need new buyers. But it also means there is less of a buffer when things go wrong. Let me bring you a few more headlines that are worth a mention. Johnson & Johnson won EU approval for its Tecvayli combination therapy in multiple myeloma. J&J is consistently one of the most cited dividend stocks across our coverage. It appeared in at least 4 separate articles today alone, alongside J&J-O and Maine for a $6,600 monthly income strategy, and alongside XOM, KMB, PEP, and MO for a $19,000 monthly blueprint. Dividend strategies are absolutely dominating the editorial calendar this week. There is a clear narrative that investors are retreating into income. Walmart was in the news on multiple fronts. The stock had its biggest one-day decline of 2022, which was referenced across 2 different publisher pieces, but Walmart is also pushing into fashion with a new clothing brand. They are selling $170 noise-canceling earbuds for $19. The Yahoo Finance summary said it plainly: Walmart is not losing any retail war. They have scale, they have pricing power, and they are expanding category by category. SpaceX is in the spotlight. D. Shaw's $912 million stake was a headline a few days ago. Today, Motley Fool asked whether SpaceX is boom or bust. The Nvidia ticker appears in that story not because Nvidia invested, but because Nvidia AI hardware powers much of the infrastructure around SpaceX's launch operations and Starlink backbone. Spectrum, Charter Communications, rolled out a free offer after steep customer losses. CHDR, VZ, T-Mobile, the cable and wireless industry is in a fierce battle for subscribers. Starlink's competitive pressure on AT&T, ticker T, appears in multiple dividend and competitive stories, remains a recurring theme. And then there is the oddball of the week. Upbit.lol, a side project from a solo founder, hit 120,000 in revenue in 48 hours and accumulated 1 million visitors. That is the kind of viral internet story that reminds us that not every massive return comes from Wall Street. A quick note on the tech sector: Tempus AI skyrocketed this week, with news links to MRK, mRNA, and the broader market. If you are looking at the AI and health tech crossover, that is one name on the short list. On the beverage side, Jim Cramer held back on surging consumer stock sell, with Coca-Cola also mentioned, a reminder that consumer discretionary names are getting re-examined after the pullback. The fake job listings story is a regulatory headline that caught my eye. 40% of companies posted fake job listings in 2024. Lawmakers in multiple states are now moving to ban them. It is an odd one, but it is a signal that government scrutiny around corporate reporting practices is accelerating. So let me wrap this up. The market took a sharp hit a wall, and is now digesting. Nvidia earnings on Tuesday are the test for whether the AI trade survives. Alibaba's $10 billion commitment signals that competition in AI is intensifying, not cooling. Berkshire holds $400 billion in cash, a giant dry powder gun waiting for the right target. Bond yields are climbing with no easy federal response. And the technical scan is decidedly bearish at a 2-to-1 margin. If we are being honest, the setup is fragile. But cash levels at BofA are near historic lows, and historically, that means buyers are scarce and any positive catalyst could trigger a sharp squeeze higher. I'll be back Monday with more market news. Until then, stay sharp.